Hi everyone, welcome to another Weekly Forex Forecast for the week ending June 19th, 2020. My name is Justin Bennett with Daily Price Action, and in today's forecast, we're going to talk about the EURUSD, the Pound USD, the New Zealand dollar versus the USD, as well as the US dollar versus the Canadian dollar. And we're going to wrap things up with the Canadian dollar versus the yen. We have several markets that look like they want to turn lower, including the euro and the New Zealand dollar, as well as some that want to break higher like the dollar CAD. We also have the CAD yen dealing with a 25-year trend line, so that's going to be a big one to watch this month. We're going to discuss all of that in today's forecast, so let's get to it right now. A quick disclaimer that today's video is for educational purposes only. All views are my opinion and are not intended as investment advice. Forex is a high reward, high risk business, and you should not trade with borrowed money or money you cannot afford to lose. See the description of this video for the full disclaimer. Before we get started, be sure to hit that subscribe button and also click the bell icon so you get notified every time I post these videos. Also check out the join button where you can become a member of this channel and receive 5 to 10 analysis videos from me every single week. I'll show you the key levels I'm watching and how I'm approaching that pair, so you'll get trade ideas from those videos, but you're also going to learn how I trade price action, and that's going to make you a better trader. So first up we have the EURUSD, and if you watched last week's forecast, you know that I was keeping an eye on that 113.40/80 resistance area. So that's the intersection of these two levels, and the first one being the top of this ascending channel. And the second one, you can see where these swing highs back here formed a trend line. All right, now notice how we did get several attempts to break through that area. However, the EURUSD never did close above that 113.80 level. And I also want to point out that the volatility back here did make things a little bit more difficult for technical traders. And that's especially true when you consider that the EURUSD is also still just moving sideways. Okay, so any trades I talk about from here on out until we get a true breakout from that multi-year wedge pattern that I've talked about several times now, and for those of you who are new, this is the pattern I'm talking about. This dates back to the 2000 lows down here, and then we're also dealing with the euro's all-time high. So until we get a break of this wedge pattern, this terminal pattern, every opportunity that materializes you have to take with a grain of salt, because until this pattern breaks, everything through here is just consolidation. So with that in mind, for the week ahead, as long as 113.80, call it 114, is intact as resistance, the EURUSD is vulnerable. I wrote about this on Friday and mentioned how 112.30/40 could still be support depending on where Friday closed. As you can see, Friday did close above it, so 112.30/40 is still support, and that 113.80 maybe 114 area is resistance. If we do see a close below 112.30, that would open up 111.50 and perhaps even 109.90. So I do want to be clear though that this rejection up here does not mean that the EURUSD will rotate lower this week. We don't know that, and as of right now, this is just consolidation up here. However, that rejection does tell me that this pattern, this channel is intact, which means that there is a decent chance that we could see a rotation lower. But first, again, sellers have to take out 112.30/40. So I entered into a small short position last week at 112.93. I also mentioned that in the forums, and I'm going to keep that position small until I see follow through from sellers this week. So a close below 112.30/40 would be appealing to me, and I'd add to that position. But as I mentioned before, all of this that's taking place above that 108 area, because remember that this region down here is the bottom of that multi-year wedge. As long as the EURUSD is just moving sideways like this, you have to be careful here because we really have no momentum. Even though we had this rally back here and we then had the sell-off, everything right now between 114 and 108 is just consolidation. So if you're going to trade this one, be careful. You might want to reduce your risk and be a little more conservative with your targets. Next up, we have the pound versus the USD, and we have a similar situation to the EURUSD. However, in this case, the pound is sitting above a confluence of support right around that 125 area. So this level extends as high as about 125.40, which is Friday's close. So notice how this trend line back here, this is the one that broke down back here and gave us that nice sell-off. However, ever since the pair closed back above this area, this 125 region has become support. Notice too, Friday's low touched right off of the bottom of that previous descending channel. So as long as the pound is trading above that 125 region on a daily closing basis, this area is intact. However, given this 2-day sell-off, look at how the pair just churned higher through here and then abruptly sold off in 2 days. That tells me that there is a lot of selling pressure up here, so I would be very, very careful. And this is not something I'd want to buy just because of the selling pressure we saw over the last 48 hours last week. I would be more interested in watching for a daily close below this bottom level for a move down into some of these recent lows. At the same time, if we do see a bounce this week, keep an eye on that 128 region, which is the top of that previous descending channel. So I'm not a big fan of trading the pound. I haven't been for some time. And just like the EURUSD, we're still just getting a lot of sideways movement. Okay, so there's not a lot of momentum here. You can swing trade this, but I wouldn't look for targets that are, 500 or 600 pips away. Instead, maybe shoot for 100 or 200 pips, just like the EURUSD, until we regain some kind of momentum here. The New Zealand dollar has been a frustrating pair over the last few weeks. If you'll remember, we had this rising wedge back here, and patterns like this typically signal a rotation lower. That's especially true when you consider this sell-off that we got back here. So we had this huge sell-off and then a rising wedge that looked like it wanted to send the New Zealand dollar lower. Instead, on June 1st, we got that close above this area, and the pair went basically straight up for several days to retest the top of that multi-year wedge. So just like the EURUSD, we have this multi-year wedge pattern that actually broke down back in March. So if you'll notice, March closed below that level. And what I said last week, and this is still what I'm watching for, I want to know if this down here is the false break, in which case we could see the New Zealand dollar move higher, or if the price action so far in June, this candle up here, is simply retesting the top of that wedge to precede a June close below that wedge pattern. In other words, June's close is going to be incredibly significant. If we see the pair close above the bottom of this channel around 62.50, that would signal strength and a potential break of the top of this wedge for a move higher. Alternatively, if the New Zealand dollar closes below 62.50, that would give us a bearish pin bar and could send the New Zealand dollar lower. So it's all going to come down to June's close, which of course we're still about 2 weeks away from that. So on the daily time frame, I mentioned this one last week where we had this rejection from resistance, and I was actually getting short here last week. Again, a small position because I want to see follow through from sellers. Thursday's session looked like it closed below that 64.30/40 area. However, Friday did recover. The best way to explain what's happening here is if we look at the weekly time frame, you can see where we have this low back here. Okay, and then we have several highs. And you can even see where we had several highs through here where the pair never did close above that 64.30/40 area on a weekly closing basis. We then had a weekly close above it, and notice how last week held above that area again on a weekly closing basis. So we could see some strength from the New Zealand dollar early this week. However, I'm going to maintain my short position. Again, it's a small position. I can get out easily if I need to, but I do want to keep that on in case we do see a close, a convincing close below this area. If that does happen though, what I'm more interested in is what happens around 62.50. Okay, there are several levels through here, including that multi-year wedge. We've got a key horizontal area at 62, and we also have the top and bottom of that rising wedge pattern. All right, so 62.50 is going to be a very critical area to keep an eye on. And that's something where if we see the New Zealand dollar sell off and close below it, even before the June close, that could be an early warning sign that the New Zealand dollar is headed higher. Alternatively, if we see the New Zealand dollar push higher and start to challenge some of these recent highs, that could be an indication of a break higher. But just like I said last week to members, this is not something that I would want to buy even in the month of June. Even if we do get a daily close above this wedge pattern, June has already moved 350 pips. And if you'll notice, most of these months, with the exception of March, these months have moved about 200 or maybe 250 pips, sometimes 300, but 350 pips in the month of June is a lot for this pair. So the odds of us closing above this wedge pattern and then taking off for another 100 to 200 pips is pretty slim in my opinion. So this is a case where I'm comfortable holding my short position up here, and if we do get a sell-off, I can always add to it. But I think that the odds of us moving much higher in the month of June are pretty slim. The dollar CAD is next, and I wrote about this one on Friday on the blog and said how Thursday's session may have closed back inside of this descending channel. So notice how we have these highs through this area, and then we have the bottom of this channel where even this low back here started it. And then we have this reaction and this one. So Friday's close clearly put the dollar CAD back inside of that channel. And the idea on Friday was to wait and see how the market reacts to that 135.60 area. All right, so I said that if 135.60 holds and buyers can close the pair above that on Friday, that we could see the dollar CAD move higher this week. All right, now one area I'm keeping an eye on is going to be 138.60. Notice all these lows through here, and then we also of course have the top of that channel. So that creates a confluence of resistance up around 138.60. Alternatively, if we see buyers give up the bottom of this channel somewhere around 135.60, maybe as low as 135.50, that would signal weakness and send the dollar CAD back towards some of these lows, including 134.20 and perhaps 133.30. Remember that 134.20 was the previous gap back here that set the dollar CAD on this massive run back in March. So we've since closed that gap and also had a nice rejection off of support. So this tells me that the dollar CAD could strengthen, but again, it's all going to depend on 135.50/60 in the week ahead. As long as this area holds on a daily closing basis, it's intact as support, and there is a chance that we could see the dollar CAD move higher into 138.60. Last but not least, we have the Canadian dollar versus the yen, and we could be dealing with a false break here above this ascending channel. So this move up here, as of right now, looks like a false break. So notice how we have this low back here, we have a high, and then we have this breakout above it, followed by this low here and also this one. However, on Wednesday of last week, the CAD yen did close back below that area, and it even went on to test that 78.40/50 area. So notice how we have several highs through this area. And in last week's blog post, the video I put out to members, I showed exactly why the CAD yen may have false broke up here, and also why 78.40/50 is so significant for the pair. So if I move over to the monthly time frame, and for full disclosure, I'm using TradingView here because my data doesn't go back this far. But if you pull up TradingView and use the data provider ICE, you get price action going back to the early 90s. And if you'll notice, we have a trend line here that dates back to 1995. So this is a 25-year trend line. And as of right now, we have yet to have a monthly close above it. Just like the New Zealand dollar, we had March close below that trend line. And right now in June, as you can see, we're in the process of forming what could be a bearish pin bar. Now, there's still a lot of time left, so that could change. But this is why that 78.40/50 area is so significant. It's this trend line that dates back 25 years. So if we see June close below that, and especially if we see it close inside of the range of May, okay, so if it closes below May's high, that would signal weakness and could send the CAD yen lower over the coming months and perhaps even years. So it's all going to come down to June's close in relation to this trend line. So as you can see, between the CAD yen and the New Zealand dollar, June is going to be a big month. Where this month closes could send certain currency pairs either higher or lower for the foreseeable future. So the way I'm looking at this now is if we get a retest of that 80 area, which is the top of that channel, that could be a selling opportunity for a move back down into 78.40 and perhaps even down to the bottom of this wedge around 76. That's if we get a daily close below 78.40. All right, 78.40 is going to be the hinge for a move lower. But I will say that if this is a false break up here, in my experience, a false break like this to one side of a pattern tends to send the market in the opposite direction. And even though we had this slight little sell-off down to 78.40, if this is a false break up here, we could very well see the CAD yen break 78.40 eventually and move down into the bottom of this channel around 76. But as always, timing is critical, especially in these markets. So again, 80 is going to be resistance with a close below 78.40 taking on the 76 area. But do keep an eye on that monthly chart because June's close is going to be critical for the pair. If you enjoyed this video, give it a thumbs up, leave your comment below, and be sure to subscribe to my channel. See you next time.